bringing now the money guys. Hey, David Dietz is with us. Scott Martin's with us. All right, equities boom, going much higher. Bond yields are plunging. The fear index is plunging. Scott, so how does this report change your way of thinking, maybe your positioning with respect to your stock positions?
It doesn't really change anything for us, Charles. We've actually been using some of this strength in some of the recent economic data to pare back just some of the winners, man, that we've talked a lot about on the show here: financials, energy, and materials. And it's not that we're bailing on those positions, but just trimming them back, taking some profits off the table, because I think a lot of this data, as you talked about with Constance there, is starting to get baked in the cake as far as how summer's going to go. And therefore, I think the market's going to likely be disappointed by better and better data as it relates to inflation as well.
Today, energy and financials, those are two sectors that are down. Almost all the rest are up. Are you putting that money to work somewhere else?
No, we're keeping it in cash for now, Charles, and then looking to maybe put it back to work in some things that fall more over the course of the next several weeks, which my guess is going to be in the technology space, maybe utilities as well.
Hey, guys, I want you to check out this headline, you at home as well. The Fed and inflation suggest a bubble is forming. Now, you know, a lot of people read that, right? They got out of the market when they said it, except the problem is that was from October 2013. When they got out of the market, well, subsequently, they've missed a 136% move on the S&P, a 300% move on the NASDAQ 100. David Dietz, what's the moral of this story?
Well, market timing does not work. And before you are all inclined to take a big move with your money, think, who are you going to be selling to? What are they thinking about? Go back to your goals. Historically, this market has outpaced cash and fixed income over the last 100 years. You know, there's always going to be some sectors that are overpriced, but conversely, there's always going to be some sectors that are underpriced. Back then, technology was very cheap. We were on the cusp of a big tech revolution. So you never want to do one thing with all your money. For every bad headline, there's also a good headline.
Yeah, the moral of the story is ignore the headlines. Okay, growth looking pretty good here, Scott. I know you're sitting on some cash, my man. What will it take for you to now look at growth, which I believe is the new value?
Yeah, it could be, and it got to a level where there is some value in growth, Charles. I mean, we just are looking for pullbacks. We're looking for entry points. We've had those in Zoom. We've had them in DocuSign. We've had them in Teladoc, Zillow as well. So just looking for points of interest or points of entry that are just basically oversold conditions. The other thing, too, I mentioned the cash earlier, Charles. You know I love gold, man. We've been picking up gold on the lows in March and April of this spring. A lot of people called us crazy as Bitcoin and Ethereum are falling out of favor because of regulation and taxation. It looks like gold is back in favor and looking to be that alternative asset class that it's always been.
Yeah, gold right around 1900 in a strong stealth rally. David, what are some of the things you're doing? What are you focused on right now?
Well, so we love growth too, but I would kind of turn it around. I don't want to look at the labels on stocks. I want to look at the companies that are going to show the greatest earnings per share growth. And there I come back to the cyclicals and the value plays. The energy stocks are leading the brigade in terms of year-over-year growth. Financials are going to come up next. And so that's where the growth is, at least through the end of the year. The secular growers did a great job, but now their year-over-year comparisons aren't going to look quite as good. Second, of course, unfortunately, I do think we're going to see higher interest rates. Who benefits from that? Who is hurt? Well, certainly the value plays where there's more earnings today, greater dividends today, are more resilient in that kind of situation versus the growth companies have longer dated things. So I would stick with those value and financials, a slight overweight there continuing.
All right, so you see this whole inflation thing still bubbling up at some point today, notwithstanding. David, Scott, two of the best. I appreciate it, guys. Have a great weekend. We'll talk soon.